I am looking at something right now that I haven't seen in 12 years of analyzing this market. It's Sunday night. The futures markets are open. If you turn on CNBC or Bloomberg right now, you'll see the usual ticker parade. They're talking about tech stocks. They're interviewing some hedge fund manager about market resilience. They are telling you to stay calm. But there is an eerie, terrifying silence about what is actually happening in the plumbing of the financial system. Look at this. On the left, the spot price of silver is sitting at 85.55 spars. That is the number the financial networks want you to believe. That is the official reality. But on the right, this is the street reality. I just checked every major bullion dealer in the United States. JM Bullion sold out of 1-ounce eagles. SD Bullion listing them at $102 with a 3-week shipping delay. The local coin shops, they went dark hours ago. Do you see the gap? $85 on the screen, $100 in your hand. The $15 gap is not a premium. It is not a spread. It is a divorce. For the first time in modern history, the paper market and the physical market have completely decoupled. We are no longer trading a commodity. We are trading a crisis proxy. And the reason why is the story that the mainstream media is terrified to touch. While you were watching the playoffs this weekend, the unthinkable happened. The Department of Justice didn't just open a review. They launched a formal criminal investigation into Jerome Powell, the chairman of the Federal Reserve. We aren't talking about an ethics slap on the wrist. We are talking about a probe into perjury regarding his 2024 congressional testimony and irregularities in office renovation expenditures. The market knows what this means. It means the Fed put is dead. It means the illusion of an independent central bank, the glue that has held this debt-ridden system together since 2008, has just dissolved. The gatekeepers are being investigated by their own government, and the physical silver market just called their bluff. Here's the reality you need to accept right now. The 85 $85 spot price you see on your phone, that is a ghost price. It is a number derived from paper contracts on the Comex, bets made by algorithms that will never touch a single ounce of metal. It is a ghost of a system that died this morning. The real price is $100. And if the rumors I am hearing from the London desks are true, $100 is just the appetizer. I have spent the last 6 hours stress testing the math on this scenario. I've looked at the leverage ratios, I've looked at the dealer inventory reports, and most importantly, I've looked at the new data coming out of the tech sector that almost no one is pricing in. If you think this is just 1980 all over again, if you think the Hunt brothers are back, you are missing the single biggest variable in this equation. I'm going to walk you through the premium gap mechanics. I'm going to show you why the silicon shield makes this rally different. And I'm going to show you exactly how I wound positioning my personal portfolio to survive the war between the Fed and the DOJ. But first, you have to understand why the paper market is about to break. We need to stop looking at the symptoms, the price on the screen, the sold-out signs, the dealer premiums, and we need to look at the disease. The silver market isn't breaking because people suddenly love shiny metal. It is breaking because the institution that prices the entire world's assets has just been exposed as a fraud. I want to start by deconstructing the headline that everyone is misinterpreting. The Department of Justice investigation into Jerome Powell. Turn on the television right now. What do you see? You see pundits debating the politics. Is the White House trying to scapegoat the Fed? Is this an election year stunt? Did Powell actually violate the ethics rules on those renovation costs? They are treating this like a celebrity scandal. They are treating it like Watergate. And because they are looking at it through a political lens, they are missing the financial mushroom cloud exploding in the background. This is not a political event. This is a credibility event. And in the world of fiat currency, credibility is the only thing that separates a dollar bill from a monopoly playing card. Let's go back to basics for a second. Why does the US dollar have value? It's not backed by gold. It's not backed by silver. It hasn't been since 1971. It is backed by the full faith and credit of the United States. But the cornerstone of that faith is the independence of the Federal Reserve. For 50 years, the global market has operated on a sacred agreement. Politicians spend money to buy votes, but the central bank stays sober. The Fed is supposed to be the adult in the room. They are supposed to be immune to political pressure. They are supposed to make the hard choices to protect the currency, even if it hurts the stock market, even if it hurts the president's approval rating. That independence is the load-bearing wall of the global financial system. When the DOJ announced a criminal probe into the chairman, not a review, not an inquiry, but a criminal investigation, they didn't just hurt Jerome Powell's reputation. They took a sledgehammer to that load-bearing wall. The market now sees the truth. The Fed is not independent. It is vulnerable. It can be bullied. It can be raided. And if the Fed can be raided, then the dollar is just a political token subject to the whims of whoever controls the Justice Department. This is the trust event, and it is triggering a psychological shift that we haven't seen since the 1930s. But here's where it gets worse. Even if you ignore the politics, even if you assume Powell is innocent, the Fed is facing a much bigger problem. A problem that can't be solved with a press conference or a resignation. They are trapped in a mathematical prison. Let's look at the hard data that the mainstream financial press is terrified to show you. As we sit here in January 2026, the U.S. national debt has crossed $36 trillion. That number is so big it sounds abstract. It sounds like a made-up number. So let's make it real. The number you need to focus on isn't the total debt. It is the cost of that debt. For the last 15 years, the U.S. government enjoyed a free lunch. Interest rates were at zero. We could borrow trillions of dollars basically for free. The interest payments were negligible. That era is over. Because the Fed raised rates in 2022, 2023, and 2024 to fight inflation, the interest rate on those treasury bonds skyrocketed. And now the bill has come due. I pulled the Treasury statement this morning. The annualized interest payment on the U.S. federal debt is now $1.3 trillion. Do you understand what that means? $1.3 trillion is more than the entire U.S. defense budget. We are spending more to pay bondholders than we are spending to pay the Army, the Navy, the Air Force, the Marines, and the Space Force combined. $1.3 trillion is more than the entire Medicare budget. $1.3 trillion is roughly 25% of all tax revenue collected by the IRS. Think about your own household budget. Imagine you earn $4,000 a month. Now imagine that the first $1,000 of that paycheck goes instantly to pay just the interest on your credit card. Not the principal, just the interest. You haven't bought groceries yet. You haven't paid rent. You haven't paid for gas. You are already down 25%. That is the financial state of the United States of America right now. And this is why the DOJ investigation is the final nail in the coffin. In the past, when inflation spiked, think back to the 1970s, the Federal Reserve had a playbook. It was painful, but it was simple. In 1979, inflation was running hot, hitting 14%. The dollar was crashing. Chairman Paul Volcker stepped in. He didn't care about politics. He didn't care about the stock market. He raised the federal funds rate to 20%. 20%. It crashed the economy. It caused a massive recession. Farmers drove tractors to D.C. to protest. People sent Volcker construction materials in the mail to show him he had stopped building. But it worked. High interest rates crushed inflation. It saved the dollar. The bears in the silver market, the people telling you to sell right now, are looking at 1980. They are saying, if silver runs too hot, the Fed will just pull a Volcker. They will jack up rates, crash the economy, and silver will collapse. They are wrong. They are dead wrong. And here's the math that proves it. Jerome Powell cannot pull a Volcker. If the Fed were to raise interest rates to even 8% or 10% today to fight a new wave of inflation or to stabilize the dollar, the interest payment on the national debt wouldn't be $1.3 trillion. It would be $2.5 trillion or $3 trillion. The U.S. government simply does not have the revenue to pay that. If rates go that high, the Treasury becomes insolvent. The government would have to default on its bonds or print so much money to pay the interest that they would trigger hyperinflation immediately. This is what economists call fiscal dominance. It means the central bank has lost the steering wheel. The debt is driving the car now. The Fed has to keep interest rates artificially low to keep the government solvent. But keeping rates low when inflation is rising is suicide for the currency. It's a checkmate scenario. Option A, fight inflation by raising rates, bankrupt the U.S. government. Option B, save the U.S. government by printing money to lower rates, destroy the dollar through inflation. There is no option C. The market knows this. The hedge funds know this. And now, with the DOJ investigation stripping away the veil of competence, the retail public is starting to know this. This is why the Fed put is dead. For those of you who aren't traders, the Fed put is the belief that no matter how bad things get, the Federal Reserve will step in to save the stock market. It's the safety net. It's the reason why, for the last 15 years, buy the dip was always the winning strategy. But you can't have a Fed put when the Fed itself is under criminal investigation. You can't have a safety net when the safety net is on fire. So where does the money go? If you're a pension fund manager or a corporate treasurer or just a guy with a 401k and you realize that, the dollar is being debased by debt math. The bonds are losing value because of inflation. The stocks are in a bubble fueled by fake liquidity. And the Federal Reserve is paralyzed by a criminal probe. Where do you put your capital? You look for the exit. You look for something that has no counterparty risk. You look for something that cannot be printed. You look for something that doesn't rely on Jerome Powell's credibility. This triggers the Exter's pyramid inversion. John Exter was a central banker and economist who created a visualization of risk. He drew an inverted pyramid. At the wide top, you have the most risky, abundant assets: derivatives, unfunded government liabilities, junk bonds, tech stocks trading at 100x earnings. This is where trillions of dollars live. Below that, you have real estate, then government bonds, then cash. And at the very tiny, sharp tip of the pyramid at the bottom, you have gold and silver. In a risk-on world, the world we lived in from 2009 to 2024, money flows up the pyramid. People sell gold to buy stocks. They sell cash to buy derivatives. They chase yield. But in a risk-off world, a crisis of trust, the liquidity flows down. It drains out of the derivatives. It drains out of the bonds. It drains out of the stocks. It all tries to rush into that tiny, microscopic tip of the pyramid. And here's the problem. The tip is too small. The total value of all the investment-grade silver in the world is tiny. It's a rounding error compared to the stock market. If just 1% of the money sitting in the S&P 500 tries to move into physical silver, the price cannot just go up 10%. It has to double, then double again, then double again. It's like trying to force the water from the Hoover Dam through a garden hose. The pressure builds until the hose explodes. That explosion is what you are seeing on the dealer websites right now. The sold-out signs are not a supply chain glitch. They are the result of the Exter's pyramid inversion happening in real time. The smart money is trying to squeeze through the door, and the door is already jammed shut. This is why the spot price is irrelevant. The spot price is tracking the paper contracts at the top of the pyramid, but the action, the real panic, is happening at the bottom. We are watching the death of a 50-year monetary experiment. We are watching the transition from a credit-based economy to a hard asset economy. And the scary part, we haven't even talked about the industrial side yet. Everything I just told you, the debt, the Fed, the inflation, that is just the monetary argument for silver. That's the reason people bought silver in 1980. But 2026 is different, because in 1980, silver was just money. Today, silver is technology. While the monetary system is crumbling, the industrial system is screaming for more metal than the miners can dig out of the ground. We have a collision of two massive forces: a monetary flight to safety and an industrial supply shock. In the next section, I am going to break down exactly how the paper market is rigged to hide this reality and why that rig is finally failing. We're going to look at the premium gap mechanism in detail, and I am going to show you why the 15-cent spread you see today is just the beginning of the divorce. If you look at your screen right now, you're seeing a lie. It's a specific kind of lie, a consensus lie. It is a number that everyone agrees to pretend is real because the alternative is too terrifying to admit. I'm talking about the spot price of silver. As I speak, the financial data feeds, Bloomberg, Reuters, CNBC, are all flashing the same number, $85.55. They present this number as the absolute truth. They tell you that this is what an ounce of silver is worth. If you go to a bank to value your assets, they use this number. If you look at an ETF, it tracks this number. But try to buy an ounce of silver for $85.55. Go ahead, open another tab, go to Appimex, go to JM Bullion, walk down to your local coin shop if they're even open. You will find two things: out of stock. Price, $100 plus. This is the premium gap, but I hate that term. Premium implies that you are paying extra for something special. You aren't. You're paying the real price. The gap between $85 and $100 is not a premium. It is the sound of the paper market breaking. We are witnessing the great decoupling. To understand why this is happening, you have to understand the casino that sets the price. You have to understand the Comex. Most people assume that when the price of silver moves on the chart, it's because people are buying and selling metal. That is false. The spot price is derived from the futures market. This is a paper market. It is a market of contracts, not cargoes. On the Comex, traders buy and sell contracts that represent 5,000 ounces of silver. But here's the dirty little secret. Almost none of those traders ever take delivery of the metal. They are hedge funds, algorithm bots, and banks. They are betting on the direction of the price. They buy a contract on Monday and sell it on Thursday. They settle in cash. No metal ever moves. No truck ever leaves a vault. It is a side bet. It is like betting on a horse race. The betting slip is not the horse. For decades, the betting slip, paper silver, and the horse, physical silver, traded at roughly the same price. Why? Because of arbitrage. If the paper price was $20 and the physical price was $25, a big bank would buy the paper, take delivery, and sell the physical for a risk-free profit. That arbitrage kept the prices together. It acted like a bungee cord connecting the ghost to the reality. That bungee cord just snapped. Why? Because the arbitrage only works if you can actually get the metal from the paper market. And right now, the paper market is flashing a warning sign that the vaults are empty. Let me give you a metaphor that explains exactly what you are seeing. Imagine the Super Bowl. The official NFL website lists tickets for $85. That is the spot price. You go to the website, you click buy, you refresh, you clear your cache, you try a different browser, same result. The price is listed as $85, but you cannot buy a ticket for $85. Does that mean the price is $85? No. It means the price of $85 is a fiction. It is a ghost. It is a memory of a price that no longer exists. Now, you walk outside the stadium. There's a scalper standing on the corner. He has a physical ticket in his hand, a real one with a hologram on it. He says, "I want $100. You scream at him. The website says $85. You're ripping me off. That's a 17% premium. He looks at you, shrugs, and says, "Go buy it from the website then." He wins. He wins because he holds the asset, and the website holds a promise. That is exactly where we are today. The Comex is the website. It is broken. The dealers are the scalpers. They have the metal, or they did until this morning. The $15 gap between spot and physical is the market telling you that the Comex is irrelevant. We are moving from a buyer's market, where the price is set by the paper casino, to a seller's market, where the price is set by whoever actually holds the metal. If you hold physical silver right now, you are the scalper. You are the market maker. You are the central bank. But it gets deeper, because the rot in the system isn't just in New York on the Comex. It's in London at the LBMA, London Bullion Market Association. This is where the new data comes in, the rumors that are circulating on the institutional desks right now. For years, conspiracy theorists have shouted about fractional reserve banking in gold and silver. They said that for every bar of gold in the vault, the banks had sold ownership of that bar to 10, 50, maybe 100 different people. It's called rehypothecation. Shutterstock? It works like a gym membership. The gym sells 5,000 memberships, knowing that only 100 people will show up on Tuesday night. It's efficient. It's profitable. But what happens on January 1st when all 5,000 members decide to show up at the exact same time? There aren't enough treadmills. Chaos ensues. The no trust event. With the DOJ and Jerome Powell was the signal for everyone to show up at the gym. My sources in London are whispering about a specific event that triggered this decoupling. A whale entered the market. We aren't talking about a billionaire. We aren't talking about a hedge fund. We are talking about a sovereign entity, likely a BRICS nation central bank or a massive sovereign wealth fund. This entity didn't just buy futures contracts. They didn't just buy unallocated silver. They demanded allocated delivery. You need to understand the difference between these two words. It is the difference between wealth and bankruptcy. Unallocated account. This is what most institutional investors have. It means you have a claim on the bank's general pool of metal. You are an unsecured creditor. If the bank goes bust, you don't own any silver. You own a lawsuit. Allocated account. This means the bank must go into the vault, take specific bars with specific serial numbers, weigh them, and title them in your name. Those bars are no longer the bank's asset. They are your property, just sitting in their room. The rumor is that this sovereign whale demanded delivery of millions of ounces of allocated silver immediately. And the bank looked in the vault, and the bars weren't there. They had been leased out, or rehypothecated, or simply sold to cover someone else's position. When a bank cannot deliver on an allocated contract, they have two choices: default, admit they are insolvent. This destroys the bank instantly. The scramble: go into the open market and buy physical metal at any price to fill the order before anyone finds out. We are watching. The scramble: this explains why the premiums are exploding even though the spot price is lagging. The banks are desperately trying to source physical bars to fill these massive sovereign orders. They are vacuuming up everything: 1,000-ounce industrial bars, 100-ounce retail bars, even coin monster boxes. They are competing with you. And here's the kicker: you cannot print silver. When the Fed needs to bail out the bond market, they click a mouse and create $1 trillion. It takes 3 seconds. You cannot print a silver bar. You have to find a mine. You have to dig the ore. You have to crush it. You have to refine it. It takes time, energy, and diesel fuel. Supply is inelastic. If the price of silver goes to $200 tomorrow, the mines cannot suddenly produce twice as much silver. It takes 10 years to bring a new mine online. So what happens when trust in the dollar breaks, demand surges? The paper market is exposed as a fraud, spot price ignored. The vaults are found to be empty, supply shock. And the miners cannot produce more. The price has to do the work. The price has to rise until it finds the point where people are willing to let go of their metal. And in a world where the Federal Reserve is under criminal investigation, at what price are you willing to trade your real money for their fake currency? $100? $200? $500? The market is currently trying to find that number. And the $85 you see on the screen? That's just the starting gun. Now, if this were 1980, I would tell you to be careful. In 1980, once the panic subsided, the price crashed because people stopped buying silver jewelry and silverware. The demand dried up. But this isn't 1980. In the next section, I'm going to introduce you to the silicon shield. I'm going to show you why the demand for silver today is not coming from panic-stricken grandmothers. It's coming from the most powerful companies on Earth, companies that cannot stop buying no matter what the price is. We are going to talk about why Apple, Tesla, and Nvidia are about to become your best friends in this trade. I want to address the skeptics directly. I read the comments. I see the tweets. I hear the voices of the old guard traders who have been in this game for 40 years. They are screaming at you right now. Get out. This is a trap. It's 1980 all over again. The Hunt brothers tried this and got crushed. Silver is a volatile rock, and when the music stops, it will crash back to $20. If you listen to them, you will lose everything. They are smart people. They know history. But they are making the classic mistake of generals who lose wars. They are fighting the last battle. They are looking at a chart from 1980 and trying to overlay it on 2026. They think silver is still just a monetary metal, a shiny rock that people buy when they are scared and sell when they feel safe. They are missing the single biggest structural shift in the history of commodities. In 1980, silver was money. It was jewelry. It was grandma's tea set. It was photographic film. Think about that demand profile. It was elastic. If the price of silver skyrocketed to $50 an ounce, like it did in 1980, what happened? Kodak invented digital sensors to stop using silver film. Newlyweds stopped buying silver cutlery. Jewelers started making thinner rings or switching to gold. The world could easily say, no thanks, that's too expensive. The high price killed the demand. That is why the price crashed. Welcome to the silicon shield. Today, in 2026, silver is not just a monetary metal. It is the most conductive element on the periodic table. It is the best reflector of light known to physics. It is the most thermally efficient metal we have. You cannot build the modern world without it. We have moved from an era of optional demand, jewelry, to an era of strategic necessity, technology. This creates a floor under the price that simply did not exist 40 years ago. I call this the silicon shield. Let me break down why this shield makes the current rally crash-proof in a way that 1980 never was. 1. The inelasticity of big tech. Who is buying silver today? It's not just the guy down the street stocking a safe. It is Apple. It is Samsung. It is Nvidia. It is Tesla. It is Raytheon. Let's run the math on an iPhone. There is a tiny amount of silver in every smartphone. It's used in the solder, the connectors, the switches, the multi-layer ceramic capacitors. Let's say, for the sake of argument, there is 0.50 worth of silver in an iPhone 17 when silver is at $25 an ounce. Now imagine silver goes to $100 an ounce, or $200. That $0.50 of silver now costs Apple 4.2 scores. Does Apple care? They are selling that phone for $1,500. The cost of the silver is a rounding error. It is irrelevant to their profit margin. But, and this is the critical part, they cannot ship the phone without it. They cannot substitute it. Copper is too slow, gold is too expensive, aluminum overheats. Physics dictates that they must use silver. So, if the price of silver hits $200, does Apple stop buying? No. They buy more to secure their supply chain. They pay the market price instantly without blinking, because the alternative is shutting down a billion-dollar assembly line. This is called inelastic demand. It means that the industrial buyers are price insensitive. They are the whales that will swallow every ounce of physical metal that comes onto the market, regardless of the price. They provide a concrete floor that prevents the price from crashing. In 1980, high prices cured high prices. In 2026, high prices are just the cost of doing business. 2. The green energy paradox. The political irony here is staggering. The same governments that are printing the dollar into oblivion are also mandating a green transition. They want net zero. They want solar panels on every roof. They want to ban gas cars and replace them with EVs. Here's the problem. They didn't check the periodic table. A standard internal combustion engine car uses about 15-28 grams of silver. An electric vehicle, EV, uses 25-50 grams. A solar panel? It's basically a silver sandwich. You cannot move electrons from a silicon wafer to a wire without silver paste. For years, the solar industry tried to thrift silver, to use less and less of it per panel, and for a while they succeeded. But recently, the technology shifted. The industry moved to TOPCon and HJT, heterojunction cells, because they are more efficient. The catch? These new cells use 50% to 80% more silver than the old ones. We are trapping ourselves. The more we try to save the planet with green tech, the more silver we devour. The more AI data centers we build, which require massive silver-heavy power connectors, the more silver we devour. According to the Silver Institute, industrial demand has been eating up nearly 60% of the annual mining supply. And that was before this crisis started. We have been running a structural deficit for 5 years. We have been eating the above-ground stockpiles. The warehouses in London and Shanghai have been bleeding inventory since 2021. We are now at the point where the cupboard is bare. 3. The supply cliff. Why we can't just dig more. The standard economist argument against a bull market is high prices induce supply. If the price of corn goes up, farmers plant more corn. Next year, you have a glut and prices fall. Silver doesn't work like corn. First of all, geology is hard. You can't just plant a mine. It takes 10 to 15 years to take a silver deposit from discovery to production. If we started building 10 new megamines today, you wouldn't see that metal until 2040. But it gets worse. 70% of the world's silver comes from mines that aren't looking for silver. Read that again. Most silver is a byproduct. It comes from zinc mines, lead mines, copper mines, and gold mines. The miner is digging for zinc. They find some silver mixed in the dirt. They sell it as a bonus. Why does this matter? Because it means the silver supply is price inelastic. If silver goes to $200 an ounce, the zinc miner doesn't care. He isn't going to ramp up production if the price of zinc is falling. He is driven by the zinc market, not the silver market. We could see silver hit $500 and global production might actually drop if we enter a recession and demand for base metals, zinc, harsh, lead, copper falls. This is the nightmare scenario for the industrial users. Exploding demand, AI, green tech, monetary safe haven, collapsing supply, base metal mine closures due to recession. Empty vaults, the stockpiles are gone. This is why I say the silicon shield protects you. You're not just betting on a currency collapse. You're betting on a supply chain breakage that is mathematically guaranteed to happen. So let's recap the battlefield. The monetary front, the Fed is broken, the debt is $36 trillion, and the trust is gone. Part 2, Section 1. The market structure front. The paper price, Comex, has decoupled from the physical reality. Part 2, Section 2. The industrial front. Big tech and green energy provide an unbreakable floor of inelastic demand. Part 2, Section 3. The bears saying, it will crash like 1980, are looking at a world that no longer exists. They are betting against physics. They are betting against Apple. They are betting against the green transition, but do not think for 1 second that the powers that be will let this happen easily. They cannot allow silver to become a giffen good, an asset that people want more of as the price goes up. They cannot allow the spot price to signal the death of the dollar. They have one weapon left. It is a dirty weapon. It is a weapon of mass financial destruction, and they are loading it right now. In the next section, we are going to talk about the Empire Strikes Back. I am going to predict exactly what the Comex and the margin clerks are going to do in the next 72 hours. I'm going to explain Rule 7 and force majeure. And I'm going to tell you exactly how to survive the volatility that is coming, because they are going to try to shake you out of your position one last time before the rocket leaves the atmosphere. I need you to listen to me very carefully right now. Everything I have told you so far, the DOJ investigation, the debt trap, the physical shortage, points to silver going higher, much higher. But do not make the mistake of thinking this will be a straight line up. The powers that control this system, the Federal Reserve, the Treasury, and the bullion banks, are not going to just roll over and let their currency collapse. They are not going to let silver scream to $200 without a dirty fight. They have a weapon. It is a weapon they have used twice before to crush rallies like this. And I believe they are loading it into the chamber right now. It is called the margin hike. To survive the next 72 hours, you need to understand exactly how this weapon works, because when they fire it, the price on your screen is going to bleed. The mechanics of the crash Remember that the spot price is determined by futures contracts on the Comex. These contracts are highly leveraged. Normally, if a speculator wants to control 5,000 ounces of silver, worth about $425,000 at 85 Oz, they don't have to put up $425,000. They only have to put up a good faith deposit or initial margin. Until yesterday, that margin requirement was around $14,000. Think about that leverage. You put down $14,000 and you control nearly $500,000 of metal. It's rocket fuel for prices on the way up. But the exchange, the CME group, has the legal right to change that margin requirement whenever they want, effective immediately. Here's the playbook I expect them to run this week. The announcement: the CME will issue a market advisory stating that due to extreme volatility, they are raising margin requirements to ensure market stability. The hike: they won't just raise it a little, they will double or triple it. The purge: thousands of retail traders and small hedge funds don't have that extra cash lying around. They will get a margin call from their broker. Broker: wire us $26,000 by 4 p.m. or we sell your position. Trader: I don't have it. Broker: sold. This triggers a cascade of forced selling. It has nothing to do with the value of silver. It has nothing to do with supply and demand. It is a liquidity flush. The algorithms see the selling and pile on. The price crashes from $85 to $70 in an hour. The media headlines will be ready. I can write them for you right now. Silver bubble bursts. Retail speculators wipe out. Is the silver squeeze over? This is the head fake, the history of the kill switch. I'm not guessing here. I am looking at the history books. 1980. When the Hunt brothers cornered the market and silver hit $50, the regulators didn't just raise margins. They invoked Silver Rule 7. They literally changed the rules of the game in the middle of the fourth quarter. They declared the market was liquidation only. That meant you were allowed to sell silver contracts, but you were forbidden from buying new ones. Imagine going to a store where you can return items, but you can't buy anything. What happens to the price? It collapses. Silver fell from $50 to $10. 2011, silver ran to $49. The banks were on the ropes. The CME raised margin requirements 5 times in 9 days. They hiked the cost to play the game by 84% in less than 2 weeks. The price crashed $6 in 12 minutes. They will do it again. In fact, if the DOJ investigation starts to look like it will topple the Fed chairman, they might do something even more drastic. They might implement position limits, capping the amount of silver any one entity can hold. How to spot the trap. So when the screen turns red, and it will, how do you know if the rally is over or if it's just a paper game? You have a truth detector. It is the premium gap we talked about earlier. Let's say the spot price crashes to $70 on Wednesday. I want you to immediately go to the dealer websites. Call your local coin shop. Scenario A, the rally is over. Spot price, $70 physical price, $75 inventory available. Diagnosis: the demand has actually dried up. You should be worried. Scenario B, the head fake. Spot price, $70 physical price, $100 or higher. Inventory: sold out, pre-order only. Diagnosis: do not sell. If the paper price drops but the physical price stays high, it means the disconnect is widening. It means the margin hike only affected the gamblers on the Comex, not the stackers in the real world. In fact, a margin hike is often the best thing that can happen for the physical market. Why? Because it forces the paper speculators out, leaving only the strong hands, the people who actually want the metal. When the dust settles from a margin purge, the price usually rips higher than before, because the people left holding the bag aren't renting the metal. They own it. The mental battle. This is the psychological warfare I warned you about. They want you to look at the chart and feel fear. They want you to think, oh no, I bought at the top. I need to sell now to save what's left. They are counting on your fear. They are counting on you being a trader who looks at the price every 5 minutes. But you are not a trader. You are an insurer. You are insuring your wealth against the collapse of a debt-based fiat currency system. Does a homeowner cancel their fire insurance policy because the price of lumber dropped 10% this week? No, because the risk of the fire hasn't changed. The risk to the dollar hasn't changed. The DOJ investigation hasn't gone away. The $36 trillion debt hasn't vanished. The industrial shortage hasn't been solved. All that happened was the casino boss raised the price of the poker chips to kick out the card counters. So when the crash comes, pour yourself a coffee, turn off the TV, look at the silver in your hand, and wait. Because once the weak hands are flushed out, the real squeeze begins. And in the final part of this video, I'm going to tell you exactly how this ends. I'm going to give you my personal exit strategy, what I plan to sell, and more importantly, what I plan to buy with the profits. We are currently standing at the intersection of three historic supercycles: the collapse of sovereign debt, the loss of central bank credibility, and the physical exhaustion of strategic commodities. Any one of these events would be enough to send silver to 100. We are living through all three at the same time. So what do? If you're sitting there paralyzed, watching the screen, terrified of making a mistake, let me give you my personal battle plan. This is not financial advice. This is survival logic. 1. If you have 0 silver, get off 0. Today, do not try to time the dip. Do not wait for the spot price to retrace to $80. In a supply crisis, the product doesn't get cheaper, it disappears. If you have to pay $100 for an eagle, you pay it. You aren't buying a coin, you're buying a put option on the collapse of the dollar. If I'm right, that $100 coin will be the cheapest insurance you ever bought. If I'm wrong, you still own a tangible asset that has preserved wealth for 5,000 years. 2. If you are already stacking, do not trade your insurance. When the volatility hits, when the margin hikes come and the paper price crashes, do not get cute. Do not try to sell high and buy back low. You might sell at $120, hoping to buy back at $90, only to find that there is no physical metal available at $90. You risk losing your position permanently. Sit on your hands. Ignore the noise. 3. The exit strategy. The question I get most is, when do we sell? My answer is simple. I'm watching the gold to silver ratio, GSR. Right now, with gold at $4,600 and silver at $85 paper, the ratio is roughly 54.1. History tells us that when silver mania truly peaks, that ratio collapses to 30.1 or even 15:1. If we see the GSR hit 30, that is my signal. That is when I will swap some of my volatile silver into more stable gold, or perhaps into income-producing land. I'm not looking to swap my silver back into dollars. Why would I trade real money for the very thing that is burning? I'm looking to trade up the pyramid of real assets. We are entering a period of time where the numbers on your screen are going to lose their meaning. The price of things will matter less than the availability of things. The media will tell you that the DOJ investigation is resolved. They will tell you the Fed has a new plan. They will tell you that digital currency is the solution. They are trying to keep you in the ghost market. But you know the truth now. You know that a promise to pay is not payment. You know that a paper contract is not a metal bar. And you know that when the trust breaks, the only thing that matters is what you can hold in your hand. Don't let the ghost price scare you out of your physical reality. The days of cheap silver are over. The days of available silver are ending. If this analysis helped you see through the fog, do not just watch the next video. Join us. Subscribe to this channel not for entertainment, but for intelligence. I will be here every day tracking the dealer inventory, the vault withdrawals, and the moves the Fed tries to hide. The crowd is still asleep, but you are awake. Stay liquid, stay physical, and I'll see you on the other side of the gap.